I have been telling you for the last 9 to 15 months that the stock and bond market are overpriced and at risk. We've talked about the fact that bonds rolled over July of 2016, and interest rates have gone up hugely since then, and they will continue to go up. You're going to get some times when they're going to come down just a bit. Those are great opportunities to refinance, but the direction of interest rates is up, and it can go up fast. Same with stocks. Stocks are overpriced and at risk. If you're my age, you cannot take that risk. Now, we've talked about corporate bonds. Corporate bonds have been considered one of the safest places you can park your money, until you get something like General Electric comes along, a 100-year-old company that was a stalwart of widows and orphans, paying a dividend consistently quarter after quarter after quarter. They got downgraded this week, and their corporate debt got pummeled, plunged. And you know who's the last ones to know? The people who own their bonds. The retail crowd, the ones that are expecting to be able to take this money month after month after month. I'm telling you that if you're my age, there is risk in the marketplace. We have talked about the fact that I have been forecasting a global slowdown. You can see it overseas. It's no longer a forecast. It's a fact. And not only am I saying it, Ray Dalio of Bridgewater Investments is saying it, the IMF is saying it, the Federal Reserve is saying it, and Goldman Sachs is saying it. Now, they're going to downplay it. This could be epic. And if you're sitting with corporate bonds and your company gets downgraded, they lose value overnight. They could lose 15, 20, 30% overnight. And we have trillions of dollars worth of corporate bonds that are sitting a half a notch above junk. And if they go to junk, they're going to lose 20 or 30%. So these companies that are marginal, that borrowed all this debt and now are facing a global slowdown where the revenues get cut in half or 3/4, they'll default. And those bonds will drop from corporate investment grade to junk to zero. And there could very well be a lot of them. So my advice is to get out of the traditional stocks and bonds investments. You've made a lot of money out of them. Now it's time to ring the register. You might want to put a lot of it in cash and just see what's going to play out. I'll tell you that I'm in the real estate business. I'm not advocating for you to put all your money into real estate. But real estate will give you a cash flow that will take you through uncertain times. And I'm looking for a correction in the real estate market. I've been forecasting that. That also is becoming a fact. We're just starting to enter into it because we're starting to see price declines. And you're going to get better pricing in 8 or 9 or 10 months. But in the meantime, you may have a requirement for income, which we could also do. So even if the properties drop a little bit in value, I think 4 or 5 years from now, they go up considerably. So my best to you, keep this in mind, that corporate bonds are hazardous to your wealth. If you want to do a year-end review, just contact us. My best. Bye-bye.